Cost segregation studies are really actually easy to explain, and they're fairly easy to understand. You accelerate depreciation, so you're accelerating deductions. Most people already understand that part. What usually gets missed is whether or not that cost segregation study you paid all that money for helped your tax situation. And that's what this video is going to be about, is when a cost segregation study will actually help your tax situation and not what a cost segregation study is. And for everybody watching, this video is going to apply to you whether you're buying a single family, residential dwelling, a fourplex, or even a 20-unit apartment. The general metrics are different between the size of property you're doing, but the effect and how it's going to play out usually is very similar. Again, most of the problems I see aren't about the context of the cost seg, but it's about the timing of it and whether or not you needed to do it in the first place. Doing a cost seg isn't just an automatic decision like a cost seg sales guy may lead you to believe. A cost seg study is a tool. It basically helps a taxpayer accelerate the deductions, the cost basis of that real estate investment that they made sooner, faster, but not always. It depends on timing. It depends on your status as a taxpayer. It depends on what actual income that investment and your other investments are throwing. There's a lot of factors there that I believe get glossed over. Something as simple as, do you flip houses versus do you hold houses long term, can throw out whether a cost segregation study should even be done. I also want to address early on that a cost segregation study, as far as a cost to the investor, looks generally a lot different for a 1-unit to 4-unit place versus a mid-sized apartment. The question's the same, whether it's a small project or a larger project, and that is, will this study actually save me money on my taxes? Or does it just appear to save me some money, but there are other factors that come into play? The other question clients usually have that don't tend to get answered on the back end of them preparing their tax return is, did it actually do what it promised? One observation I've made about cost segregation study assumptions is that everybody is a real estate professional and everybody is going to get to fully utilize first-year deductions. And unfortunately, that is just not true for most people who end up getting a cost seg study done prior to talking to their CPA. Whether you're a real estate professional or you're just a passive real estate investor, the benefit of that election gets lost on a lot of people. It's usually one of two buckets. First bucket is highly compensated individuals are looking for anything they can do to lower their taxes. They read about real estate professional and they're convinced their first couple projects, they've spent enough time to meet the qualifications. Or you have a clear, bright test of meeting the real estate professional election qualifications, like a general contractor who materially participates in real estate activities, or a realtor who spends well over 750 hours and 50% of their time in real estate activities. But they have no capital. They have no money to invest and create these tax deductions. That seems to be like the push-pull of this magical election. But keep in mind, the benefits of the real estate professional election tend to go down for true real estate investors year over year because their portfolio is growing and the rental income is growing, and the need to offset other income sources wane or recede. And what they're now facing is just needing to offset their other rental income. So for even the passive investor who's now grown a portfolio to 5-10 rentals, we may be rebroaching a subject with you that your advisor or CPA told you years ago you shouldn't do it. It's not going to benefit you like they're saying. One example of when a cost seg study may not make sense to perform it is when you're in a larger project where you're going to have to pay for an engineered study and you're going to have to put $5,000, $10,000, $15,000 out for that study. However, that project's heavily leveraged. There's a large debt service interest expense that's hitting the bottom line. There's early CapEx expenses, maybe to update the place after purchase. And so there are a lot of sort of heavy hitting expenses early on. And so when you run out to do the cost seg study, that money you're sinking into it, you're going to get no first year return on that investment unless there's some real estate professional election that's allowing you to take those excess losses outside of that real estate investment and offset other income sources. Keep in mind, if you're just starting out in real estate, you should be talking to your advisor and getting a real good prospectus on how the rental is going to perform in the early year or two. Now, there are things that allow for doing cost seg studies in the future and making up the lost accelerated depreciation benefit. And under our current rules, the year you take those deductions for accelerated depreciation is the year that you perform the cost seg and elect to do a change in accounting method. So again, doing the study year one is maybe not the best decision. So I'm not trying to be hypercritical to anybody out there that sells this stuff or anything. And that's because you're not going to get a return on that investment that you made to pay for that study. Now, smaller projects, there are a lot of cheap next to free tools out there to do sort of a program calculation or calculator. And for $500, you can get a report. That's not a huge investment to potentially offset a few extra $1,000 even in year one. It's going to pay for itself. So just keep in mind, sometimes deductions already exist. And so if your advisor is saying, I don't think that's a good idea, they're probably aware of things like that, or that you're not a real estate professional. It's not that they're saying a cost segregation study never makes sense. It's that they know your picture. And so sometimes you have a duplicitous relationship between the person who wants to perform the cost segregation study for you and the advisor that has a good idea of how it's going to affect your return. Other times, your advisor might be a little in the dark about what the real workload is or cost, and maybe just doesn't want to deal with it. So that's on you to feel that out. Here's the part I never heard talked about. The cost segregation provider, the cost segregation study provider, is usually 100% separate from the advisor. That's not true all the time. There are definitely larger CPA firms, tax preparation firms out there that have in-house cost segregation engineers and people who perform the studies. But generally, these folks who perform these studies get in front of taxpayers through their own marketing and whatnot and get meetings set up and show them their benefit without their advisor being part of that process. It's not always that way, but I've been doing this long enough where, surprise, my client has gotten a cost segregation study done on one of their apartments or smaller single family type rental homes. And it's always an interesting conversation because in their mind, they were told it's going to save on taxes. We get the numbers in there and it doesn't end up saving them X on taxes because there were some assumptions made that weren't entirely accurate. Whether those assumptions were tailored to the client specifically, but maybe based on their prior year tax return versus it being based on the explicit facts of that tax year that they were doing the cost segregation study. It's just a fact of life. And I don't think it's a bad thing necessarily that there are providers out there trying to bring potential benefits to taxpayers. I mean, that's what I'm doing these videos for, is to basically share some of the things I've seen to the masses who watch the videos. And that's actually a good time to segue into like, hey, if you're getting any value out of this video, please like, subscribe, or put a comment down there. Maybe comment whether you've done a cost seg in the past. I appreciate any of the support. And Yeah. So when these cost segregation studies are done outside of looking at the taxpayers' actual tax returns and their actual fact patterns, they're usually based on a top marginal rate. So right now for federal, that's 37%. They're based on perfect participation, meaning you're like a real estate professional versus this is going to be passive. You don't have any other rental income to speak of. And this thing is going to be isolated to just being able to offset the rents of the property that you're doing the cost segregation study on. And so this comes back to the fact that the study, the idea of breaking out assets and accelerating depreciation, the study isn't wrong. It's just that the timing of the study for the taxpayer isn't going to deliver what they were thinking. Another thing that I fear doesn't get discussed enough is holding period. So I have investors who may only spend 2 years on a property, 5 years on a property, and they may be working towards a retirement, or their ordinary income is actually going to be trending down as they prop up their investment portfolio and work on it and sink money in the way of repairs and new appliances and repaving the parking spots, etc. And so holding period is really key when you're thinking about doing a cost segregation study as well, because anything you get from the IRS in the way of accelerated depreciation, you're supposed to follow that when you sell the property. So we're talking about 1245 recapture, ordinary income on the 5-year stuff, and then 1250 recapture on the accelerated depreciation linked to land improvements and the real property side of things. And that could be a windfall depending on the makeup of the project and did the market appreciate a lot. And it's going to throw you potentially net investment tax and all these other areas that you maybe weren't in because you've basically had to recognize all this income. Whereas if you had been just depreciating over the first year, second year, and you maybe didn't get that benefit in some of those lower tax rates, you would have had a lot more basis to go against that sale. So your income wouldn't have been jacked up, and maybe you didn't find yourself in net investment tax. It's a thing that gets glossed over when you hear the bells and whistles around speed up, hurry up, take depreciation now, get the tax benefit. You really want to be looking like at least 5 years out. Like, what's your long-term plan with this property? Okay, so we're well into this video, and I've got to say, I'm actually a huge fan of doing cost segregation studies. You can go to my website. I actually have an online tool that's completely free that'll do like a 1 to 4 unit around $1.5 million in tax basis for free. And if you watch any of my other content where I'm talking about real estate, I'm almost always bringing up the benefits of doing a cost segregation study and accelerating depreciation and getting that first year big deduction. But I'm talking to a subset of real estate investors that can hopefully utilize those accelerated deductions, whether they're a high income earner with a spouse who qualifies as a real estate professional, or they're somebody who's a seasoned real estate investor who has lots of passive rental income that they're looking to offset versus paying taxes on it today. So, I mean, the FYI of this whole video is, hey, hit the brakes, try to talk to your advisor about it. If you get stonewalled and you don't feel like they're giving you a good reason, maybe go out for a second opinion, but don't necessarily sign on the dotted line and pay a large deposit to get a cost segregation study done until you actually have a really good idea of what the benefits are. And not to say some people helping you with your cost segregation study aren't going to do a more detailed projection or plan on your income types and what it will help offset, but just a real generalized experience on my end is that a lot of times the details get overlooked in terms of how it will actually benefit a taxpayer. So just remember, like, a cost segregation study isn't the strategy. It's just part of a larger plan. When it's done in isolation, expect the unexpected. Expect it to not go as well as you had hoped. Expect it to maybe underdeliver a little bit. When it's done in partnership with your advisor or somebody like me, you usually should have a very good, clear idea of exactly what the benefit will be year one And we should be able to even like push out to year 2 and explain to you what benefits you're really going to see there. That's the type of planning we do here at William Neal CPA. We try to get things out in front and really understand how these tools we try to employ and use with our clients are going to deliver at the end of the day before we pull the trigger. If you're still trying to figure out how a cost segregation study could help you, feel free to reach out to us at www.neil.tax. I've got some links all over the place for scheduling a fit call. Thanks. I hope you enjoyed the video.